Hi, it's Kris Benson. I'm the Chief Investment Officer at Reliant Real Estate Management. Today we're going to walk through our most recent investment opportunity, Reliant Self-Storage Fund 1. I'm going to walk you through the slides, give you a little bit of insight into why we created the fund. And we'll walk through the slides fairly briefly, so if you want a more in-depth look to the slides, there's a link down below the video where you can download the slide deck and follow along with us. So let's get started. Just really quickly, from a disclaimer standpoint, I always want to make these points salient and clear that many of the statements we make in these types of webinars and in our investment summary are forward-looking statements. We're making projections based on the information we have and our experience, but understand that there's risk in every investment. And I'd encourage you and your financial professionals or legal professionals to look through all the documents to ensure this is something you understand what we're investing in. So with that being said, a quick table of contents. We'll walk through the executive summary, the why behind the fund. We'll take a look at the terms. I'll quickly introduce the Reliant team. For many of you who watch this video, you know who we are. And we have previous videos specifically about Reliant if you're looking for a more in-depth look. We'll talk about the strategy, and then there are 10 properties that we've already named for this particular fund. We'll go through a few of them so you can get the flavor of the type of property we're putting into the fund, but we won't go through all. We'll leave that up to you. So just really quickly getting started, what is the Reliant Self-Storage Fund 1? Well, it's a self-storage acquisition fund offered through 506C offering, Reg D 506C. So this is available to accredited investors. What it means to be an accredited investor essentially is there's two tests. You have an income test and a net worth test. The income test is you have to have made $200,000 a year for the last 2 years, single income, or $300,000 for the last 2 years as a dual income with the expectation that you're going to make that money moving forward. Or you have to have a net worth of in excess of $1 million, excluding your primary residence. So this fund is for accredited investors through a 506C, and essentially what it is we are using the fund to acquire commercial self-storage properties across the US and also recapitalize a couple properties that Reliant already owns, and we're going to roll those into the fund as well. And the goal of this fund is really to create outperform the market from a return standpoint and create some passive income opportunities for our investors. So some details on the fund: we'll be raising $15 million as a minimum. The fund will be capped at $50 million, that's 50. And already we have 10 properties that are named for this fund and under contract currently, which make up about $35 million in equity requirements. So we've left ourselves a little bit of room to add additional properties if we find properties that fit the strategy of the fund. Right now, those 10 properties I mentioned are across 4 states. So our goal with this was to be able to allow investors to get diversification specifically by asset, right? So you're not tied to one specific market, but then geographically to give you diversification across multiple states. And if you're thinking of this in traditional investment terminology, think about mutual fund versus individual stock. In this case, this is a mutual fund where we're putting a bundle of projects together in a portfolio, and you as the investor are investing in all of them. Versus an individual stock, which would be an individual syndication for us, where we bring you one property and you invest just in that one. So we're excited to bring that to you. Our projected annual cash-on-cash return for our Class C investors, and I'll walk through what those are in just a second, is 16% a year. And you can see on the bar graph here, we're planning our cash-on-cash returns to be 4% in year 1, 6% in year 2, 7% year 3, 8% year 4, 8% in year 5, and then 10% in year 6. Now those are the cash-on-cash returns if we don't sell the property. If we were projecting this project to be a 6-year hold, when we sell the properties in year 6, we're expecting a 16% annual return for our investors over that 6-year hold. So it's a strong investment opportunity in our opinion, and we believe that there's a little bit of upside here for our investors, and I'll walk through what that looks like. One thing to keep in mind is, and there's a disclaimer at the bottom of the slide, these projects and our projections are all based on the 10 properties that we have currently under contract. Those could change. We could decide not to buy some based on some due diligence we're doing as we're going through our underwriting. Or it could be a bit of a change as we add additional properties to the fund. So just keep that in mind that we're not locked into these 10 properties, although they are under contract, and as of today, we expect to close on each of them. So really quickly going through a few bullet points about Reliant Real Estate. If you don't know who we are, we're a commercial self-storage operator out of Roswell, Georgia, which is just north of Atlanta. We were originally founded in 2005 and bought our first properties in 2007. Today, we're the 27th largest self-storage operator in the United States. We have 47 properties that we own and another 4 that we do third-party management in. We have in those 47 properties just over 30,000 units and a portfolio valuation of just over $310 million. So we have a deep understanding of self-storage and how to acquire it and how to manage it. One thing to keep in mind is we are also vertically integrated, meaning we buy the asset, but then we also run it. So it is our employees who are managing the facility itself. Our leadership team has over $590 million in self-storage transaction experience, combined over 50 years of experience in the market. So, we understand the asset class, and we've had a fantastic track record, which we'll go through in just a second. In regards to the fund, one thing that we had not talked about yet, we plan on the first property closing to be June 27th. The fund will be open through December 31st of 2019, and it'll be first come, first serve. So we'll either raise money until we hit that $50 million threshold, or potentially we may not have any more projects to buy, and we'll close the fund. So our strategy is really to acquire and manage value add and core plus or stabilized self-storage assets in the United States. We'll focus on assets that have really high visibility and traffic count, strong population growth in the markets that they're in, and undersupplied market dynamics. The fund is really designed to create passive income for our investors, and then ultimately with the sale, outperform market returns based on the value we think we can create in these properties. Now, really quickly on Reliant's track record, I think as investors you should think about the partner that you're partnering with in this particular property, or in this particular investment, and our track record's been pretty exceptional. There's some additional slides about our track record at the back of the deck, but I just wanted to give you a quick snapshot. We've sold 21 properties in our time as a real estate operator. Our average internal rate of return is just over 45% a year at the project level, and our average equity multiple is 2.93 times. So what that means is for our investors, if they invest $100,000, we return to them $293,000 on average across those 21 properties we've sold. So our average hold time is just over 3 years. So again, if you invest $100,000, on average we returned $293,000 to you in a 3-year period. And then lastly, if you break that down over an annual return, our annual returns was just about 67% a year. So we've had a phenomenal track record thus far. We are very conservative underwriting, so you'll never see us underwriting to these numbers. And I think we've also been the beneficiary of a very strong real estate market. So what we're trying to underwrite to in funds like this is, that future downturn. Because as you guys know, trees don't grow to the sky. There is going to be a correction. So we're trying to do our best to mitigate what that looks like. So moving on to the next slide, just looking at the actual terms of the fund. The name of the fund legally is Reliant Self-Storage Fund 1 LLC. That's what you as the investor will be investing in. You'll be a member in that particular entity. We talked about the strategy already. We're going to buy value add and stabilized self-storage assets in the United States. Our target fund size, the minimum is $15 million, which just means we have to raise $15 million before we can close on our first property. And we have the option to extend that up to $50 million, and then the fund will close. Capital call period, when we're going to start raising money, we'll start collecting our subscription documents. Will be out this last week in May. And so we'll start collecting money in June, and we'll move forward from there until we hit that $50 million threshold. Our projected fund term, how long we expect to hold it for investors, is 6 years. Keep in mind that that isn't a hard number. We could hold it longer, or we could sell the asset sooner. We're a opportunistic investor in that if we can get our investor returns in year 3 that we projected in year 6, then we're probably going to move forward with getting those returns done. So just something to keep in mind, that this is money that you probably want to think about you may not need for a significant period of time, because it's a very illiquid investment in that there's no opportunity for you to get those monies out until we return that capital either at a sale or refinance. So let's walk through the fee structure on the fund. There are 4 fees, 2 that are paid at closing, and those are one-time fees, and then 2 that are paid into perpetuity. So you're paying those 2 fees to Reliant annually or on a quarterly basis, depending on the fee. So the 2 fees that are one-time fees is the acquisition fee, and that's 2% on the total cost of the project, and that's paid one time at closing, and that just helps reimburse us for the costs of going out and getting these properties. And then a development fee, and what the development fee is, if there's construction on the property and there's a capital expenditure budget. And all a capital expenditure budget means is there's a budget to do construction. We charge 6% of whatever that capital expenditure budget is for our construction team to manage that process. If there's no construction on a particular project in the fund, then there's no 6% fee. So those are the 2 one-time fees. The 2 fees that are paid annually or on a quarterly basis are the investment management fee, and that's 0.65% on the equity raised. And that's annualized, so it's 0.65% equity raised over a 12-month period. And that's paid to Reliant on a quarterly basis. And that helps cover the investment arm of our business, the investor relations, having the staff to manage the paperwork on the back end, the accounting at the end of the year, etc. And then the second reoccurring fee is our property management fee. And as we had mentioned earlier, it's our team who are running the facilities. So we charge 6% on the gross revenues of the property to cover the costs of our operations. So that pays the salary for our managers, the site managers. It's paying for some of our internal costs to support those managers, our marketing function, accounting, etc. So again, 4 fees, 2 paid at closing, acquisition development fee, and then 2 paid into perpetuity as long as we have the fund. The property management fee, 6% of revenues, and then our investment management fee, 0.65% of the equity raised. And that's it. There are no other fees. There's no disposition fee, loan guarantor fee, nothing else when it comes to the fee structure. So it's pretty straightforward. Let's walk through the terms of the fund and the investment structure. So we have 3 classes of investment member for this fund, and they're based off the amount of money invested with a minimum investment that differs for each class. So our Class A membership is a $5 million minimum, and that Class A membership gets an 8% preferred return and an 80-20 split. Our Class B is a $1 million minimum with a $1 million minimum with an 8% preferred return and a 75-25 split. And then our third class is Class C, and that's a $50,000 minimum with an 8% preferred return and a 70-30 split. So we have that structure, and then there's something called an IRR hurdle. And what that means is if we outperform our projections and hit, in our case, a 15% IRR, and what IRR stands for is internal rate of return. So if we hit a 15% internal rate of return, then the splits, Reliant regains more ownership. We share in more of the upside. So the structure goes as we just described. For the Class A members, it's an 88% pref, 80-20 split up to a 15% IRR. After the IRR, it goes to 70-30. So Reliant gets another 10% back. In our Class B, it's 8% preferred return, 75-25. Once we hit the IRR hurdle, then it goes to 60-40, so a little more attractive to us. And then in our Class C membership, it's an 8% preferred return, 70-30 split. And if we hit that IRR hurdle, then we go to a 50-50 split. And the goal of that really is for us to outperform. The fund is projected to return about a 14% IRR. So that means we've outperformed our projection. And if we do that, we want to be able to share in the upside. All right, so shifting gears of how the money gets paid out. So there's 2 types of distributions from the fund. One is a distribution from operations, right? So this is the money that the properties make when after they pay their bills. So the rents come in, they pay all their expenses, and there's a distributable cash flow available for our investors. And how that gets split, let's do it with the Class C share. So with Class C, we first have to pay our 8% preferred return, and then if there's any money remaining, it gets split 70% to the investor and 30% to the sponsor, or in this case, Reliant. In the second way that the properties or the fund makes money is through a capital event. And that could be either a refinance or a sale. And in that case, first we pay the 8% preferred return. Then we have to return 100% of your principal. Then we split 70-30. So the structure is set up where before Reliant gets to share in the profit, that ultimately investor gets their preferred return, and in some cases 100% of their principal, and then we share in the profits for the property. And I think that's a good alignment of incentives for both the investor and for us as a sponsor. Okay, so let's talk through what our co-investment, so what Reliant is putting in the fund. We're going to put 1% of the aggregate fund in cash. So if this fund goes to $50 million, the principals at Reliant will put in $500,000 of their own cash, plus an additional $210,000 of cash. So if this goes to a $50 million fund, Reliant will have $710,000 in cash in the deal. And then secondarily, Todd and Lou, who have an ownership stake in one of the properties we're recapitalizing in the fund that Reliant already owns, they're going to roll their $200,000 ownership stake into the fund. So it's not straight cash, but they are taking their ownership and putting that in the fund as well. One other thing to consider on the skin in the game is many of the debt structures we have on these properties are recourse, which means someone has to sign a personal guarantee on the loan. And so essentially any property that has construction to it, most of our lenders are going to require us the principals of Reliant to sign on the note. And so when we talk about skin in the game, we have cash in the deal, but then also the principals are signed on the dotted line for the loan. So if something happens with the property, they're coming back to get us personally and our assets personally. So I think that's one thing you want to consider when you look at the skin in the game is really the cash is important. The skin in the game is we're signing on the note for the actual debt. Okay, two other things and then we'll shift gears. Restrictions on investment size. So the fund can't invest more than 35% of the total fund, so just over $12 million in any one property. And the goal of that really is to make sure that we're staying diversified and your money isn't over leveraged in one particular property. And then from a leverage or a debt standpoint, the fund is requiring that at the aggregate fund level, we won't exceed 70% loan to value on the debt. So all of our debt right now, it hasn't all been finalized, but our average loan to value on the properties and the term sheets we've received thus far is about 68%. So you won't see that exceed the 70% loan to value. All right, really quickly, I'm going to go through our team and primarily 3 or 4 of us. There's more detailed biographies on each one of our team members at the end of the deck, and I'll leave that to you to go through them. The 3 or 4 people I want to highlight are our 2 managing principals, and that's Todd Allen and Lou Pollack. Both have a deep understanding of storage. Lou bought his first properties in self-storage properties in the early 80s. And Todd, prior to starting Reliant in the early 2000s, Todd worked for the nation's largest self-storage REIT, private self-storage REIT, on the operational capacity and underwriting. So he's had significant experience in the asset class. And actually how Todd and Lou met was Todd was looking at a property that Lou was selling and his company was buying. And then they ultimately created a management company that ran Lou's properties. And then they said, hey, let's buy some on our own. And long story short, that became Reliant. The other 2 I want to speak to really quickly is John Cordova, who's our Director of Acquisitions. John has been in the industry in storage for 20 plus years in a multitude of different facets, most recently in the appraisal world prior to joining Reliant about 3 years ago. So he has a really good understanding of the market and the self-storage asset class. And John, myself, and Todd sit on the investment committee where we're ultimately making the final decisions on what properties we're buying and essentially ensuring they fit the strategy of Reliant moving forward. And then the last person I just want to highlight is Colin Van Dyne. He's our Director of Operations. And Colin has actually experience working for the world's largest retailer in Walmart, and we stole him away from there, and is a fantastic person in creating systems and managing. We have almost 160 people who work for Reliant, and so Colin's done a fantastic job managing them, creating performance audits so that we're ensuring we're driving the revenue in each one of our properties. So there's a link in the slide, actually, a shortcut to the biographies if you so desire. But the next thing I want to touch on just very briefly, and there's actually a separate video specifically about why we think self-storage is a great investment asset class. But there's three things that I think storage stands out when you look at it compared to some other real estate investments. The first one is returns. Everyone wants to talk about what have the returns been. And that's critical. I understand that. So there's a reference to the data set we're using. It's the National Association of REITs. So what that is they track all of the publicly traded REIT data for each asset class and sub-asset class in real estate. So it's a great way to do some apples to apples comparisons around how did apartments fare versus storage and office versus retail. So I looked at 25 years of data for storage, so from 1994 through 2018, and storage performed at just over 16.8%, so almost 17% a year, which is incredible, especially when you compare it to some of the other asset classes. So apartments did just over 12% or almost 13%, retail did just over 12%, office just over 12%, and the S&P 500, for a baseline comparison, did just over 7%. So really storage outperformed not only some of the, I would argue the sexiest commercial real estate asset classes, but also on the equities market, really outperformed what they had done in the last 25 years. And I think the next logical question is, but what happened in the last recession to storage? So we looked at the same data from 2007, 8, and 9, and in 2007, 8, and 9, storage lost less than 4%. And how does that compare to some of the other asset classes? Let's walk through them. So apartments lost just under 7%. Retail, which you'd expect, lost a little bit more, 12% a year. And then office, about 8%, and S&P 500 lost just over 21%. So significant losses. And I think as we as investors look, what we want to ensure is that there's a return, but the capital preservation is number one. Warren Buffett always says the first rule of investing is don't lose money. The second rule is don't forget about rule number one. So storage really did a really nice job showing some recession resilience in the last downturn. And I think that just comes from American materialism. We just don't get rid of our things. Even when we're downsizing, we save our stuff. And I think it's because we have this hope for a better day. And we're going to need that stuff again someday. So did really well. The third piece that I think is critical is the self-storage market is owned by, there are 6 publicly traded companies that own about 20 to 25%, depending on what data you look at, of the marketplace. And so I think what's interesting on that aspect of it is it provides a huge market consolidation opportunity for companies like Reliant. So, there's still a lot of mom and pop operators where those mom and pop operators may have 1 store, 2 stores, and not running the investment or running the property like a business. So we can go in there and create some revenue enhancements and really some efficiencies for our investors by helping to consolidate that market. So I think that's a good overview on why self-storage. Let's shift gears to Reliant's underwriting process. So as you look at Reliant's underwriting process, I think the key things you want to understand is, how we go about buying a property. And I'll let you read through the slides, but I want you to understand that it's a pretty in-depth and educated process. The thing about storage that matters is it is very much a micro market. So what really matters is not necessarily the MSA or the market that the asset is in, right? So if I say, hey, I'm buying a storage property in Atlanta, that doesn't really mean anything. What matters is the 1, 3, and 5 mile rings around the property, because most tenants for storage are going to come in that 3 to 5 mile radius, 70+%. So what you really need to understand from an underwriting standpoint is that micro market in which you're involved in. So we do a really interesting thing that I'm always fascinated by the data that comes of this. When we're looking at a property, we get a list of the tenants that live or that rent from that property. And then we map them. So we get an address list and then we geomap them to say, okay, here's where all our tenants are coming from. And you can see on the map where they cluster from. And why this is interesting is, one, it helps us focus our marketing efforts if we choose to buy the property. But two, you also see these man-made barriers. Things like highway overpasses. For some reason, tenants won't come from the other side of the highway. Now, there's an underpass, you can drive right through it, but it's interesting. One of the properties in this fund in Tampa, in the Lutz, Florida property, Highway 75 goes not too far away from the property, and tenants don't come from the other side of the highway. I don't know why, but it's interesting. So it's a very much a sharpshooter's game, and understanding the intricacies of that 1-3-5 mile radius to understand if it is a property that we want to be in. So as we had talked about, we walked through individual steps in the underwriting process, but I just wanted to give you that insight into what our strategy on the underwriting side is. And then property by property strategy, for those of you who Reliant is new and our business plan is new, what we typically do is we're going to build a business plan for a particular property. And most of our properties at this point are value add type deals where we're doing some sort of expansion to create forced appreciation. We're not expecting the market to bring the values up. We're going to drive the values up by growing net operating income at the site. And so sometimes that's an expansion. We're going to build a building, we're going to add a building and get that leased up. Sometimes that's revenue enhancements on the site, just raising rents, running tenant insurance, adding truck rentals, those kinds of things. But each business plan is different. We're going to share that with our operations team once we buy it, and then the operations team is going to go through and run the facility and execute on those strategies. And then our exit strategy for most of our properties is, once we get the asset stabilized, we're going to look to maximize the value. And in some cases that may be, hey, can we refinance it, give the capital back to our investors, and then we all just collect cash flow if it's in a market that we like with a really strong asset. And in some other cases, we look to sell it. We just sold 2 properties to a publicly traded REIT in April. We have a pretty good relationship with 2 or 3 of the major REITs. So when we want to sell a property, we'll typically bring it to them off market, and they'll give us a pretty good look. But our goal, honestly, is to maximize investor value and our own, and we're going to do whatever we think will do that for both of us. Our incentives are aligned in that. So let me give you some more insights into the fund, some of the key statistics around the fund, because I think this is important, based on the 10 properties we currently have under contract. Now keep in mind, those could change, but I think some of these key statistics will help you understand our underwriting and the assumptions we're making in our pro formas to develop the returns we're showing you here. So the total acquisition cost on the 10 properties we currently have under contract is just over $91 million. The total equity we'll need to do that is just about $35 million. We'll have just under 7,000 units at completion in that portfolio, 990,000 net rentable square feet. Our projected loan to value based on the loans we currently have secured and the ones that we're working on, not all of the loans have been finalized yet, but some of the term sheets we've seen is 68.2%. Now, as I had said earlier, we cannot exceed, based on the subscription docs, 70% loan to value. So we feel like we're right in the ballpark there. Our average exit, fund level exit cap rate is 6.86%. And for those of you guys who don't know what cap rate is, there's actually a previous video where we walked through some of the descriptors of it. But essentially the cap rate is how we're projecting the value when we sell these properties. And to give you a sense, a lower cap rate means typically the property value is going to be higher. So we just sold that 2 property portfolio that I mentioned in April, and our cap rate was sub 5%. We're projecting that the properties we sell will be at 6.86%. So what that means is we're building in some fluff. We're assuming the market is going to get worse. So as time goes on, perhaps there's a market correction. We're assuming market will get worse, and so we're projecting that in our pro forma. Now, if cap rates stay where they are today, 6 years from now, then boy, we're really going to outperform what we've said. But it's a trees don't grow to the sky. There is going to be a correction, and we're trying to mitigate the risk on that. Average projected rent growth, years 1 through 6 at the portfolio level is just over 4.5%. So what we're basically saying is we're going to, if rent was $100 this year, next year it's going to be $104.50 for that tenant. And that's spread across the whole portfolio, but just to give you a sense of our average projected rent growth. Our expense growth in our projections is about 3%. In some cases, it's higher. Taxes typically are going up more than 3%. But at a minimum, our utility bills, marketing costs, we're raising those 3% a year. So our rent growth is a little bit more than expense growth, but not significantly where we don't think we're going to be able to achieve that. And then the last piece is the average stabilization rate. So across the portfolio, what's the occupancy we're projecting once we hit stabilization? And that's 86%. And that may sound low, especially for investors who've seen multifamily investments. The key there with us is we try to focus on the economic occupancy. Once we get above 85, 88%, we're going to raise prices on those units and start to drive people out and rent in new people at that higher rate. So 86% is where we stand today on the fund level as far as stabilization. And we think that's pretty achievable based on the markets we're going into. So lastly, we're going to get into the acquisition pipeline of the fund itself. So I had mentioned we have 10 properties, and you'll see on the slide there's actually 7 individual properties. One of them, the Midgard, Alabama portfolio, that's 4 properties. So we have 7 individual projects, and one of them has 4 properties, so that's where we make up our 10. What I'm going to do is walk you through a couple, just for the instances of time, to be respectful of your time. I'm going to walk you through a few key projects that I think you should understand how they're set up, and let you know a couple of other items. You can dig in more detail. You'll also have access to download all of the due diligence documents on each one of these properties. So you can go in and see the pro formas month by month for the full 6 years, so you can see the assumptions. And also our comp studies, our competitive studies that show our analysis on the particular market that we're going into. So I'm going to jump just really quickly, to the map slides. I think you guys understand we're in 4 states, so we get some nice geographic diversification. The next slide after that is just showing where those markets are that we're in each particular state. But I want to walk you through a couple properties and some things I think you need to understand about the portfolio we've already assembled. The first property I want to walk you through is Lutz, Florida. And this is a submarket just outside of Tampa that's been growing in leaps and bounds. Just to give you a sense, the population growth from 2000 to 2010 was 99% in a 5-mile radius of the property, so a huge jump. And in the last 8 years, from 2010 to 2018, it was 22%. So there's a lot of influx of people there, which typically is going to drive demand on the storage. This is an interesting property, and the reason I bring it up is there's no value add here. It's a stabilized asset. We have some revenue enhancements we're going to be able to make. But I think the thing that I want you to understand is this is one of those properties that was owned by quote unquote mom and pop operator. The gentleman who built it has been the only owner. He built it originally in 1998 and had done multiple expansions, done a fantastic job with it. But to give you an example of how he was running his business, there was a number of tenants that have never received a rental rate increase. So if I rented a unit in the year 2000, I'm paying the same rate in 2018 as I was in 2000. Now that doesn't mean he hasn't raised his rates over the years. He has. If I'm a tenant coming in 2018, I'm paying a different rate than my tenant in 2000. But from a business standpoint, that's really challenging. So in our pro forma, we know when we raise rates on that guy who's been there since 2000, he's probably going to get upset, when we bring him up to the market rate. So we may lose him. And in our pro formas, we show initially as we raise rents, occupancy is going to dump out. But because of the market growth, we feel like we're going to fill that back in and they'll all be paying at the higher rate. So this is just one of those examples, I think, to when we talk about market consolidation, these types of opportunities still exist. The other thing at this particular property, the traffic count of 73,000 cars a day, that's incredible. It's right on Route 54. And 73,000 cars a day, just to give you perspective, we're typically looking for 10,000 cars or more. So this is like a major highway type traffic that's right in front of the site. So I'll let you look through the particulars on the investment metrics. but it's a property we're excited. It has fantastic cash flow, and we're excited to have it as part of the fund. Okay, there are 2 properties I want you to be aware of that are part of this 10 that Reliant already owns. And when I say 2, I should say 5. The Midgard, Alabama portfolio is 4 properties that we already own, and we're going to be recapitalizing those investors out of that investment entity. And the reason why is we have a preferred equity position in that investment that helped us do the value add construction. On 2 of the properties, we did a significant construction project, and this pref equity helped us with that. But the pref equity is very expensive from an interest rate standpoint. So we're recapitalizing those investors out so that we can get new investors in and take advantage of a value add once the construction is complete, and then we just have to get the property leased up. So that's the first property in Reliant's portfolio currently that we'll be recapitalizing. And I'm going to skip 2 slides to get to the Melbourne property. Now, Melbourne is a property that we currently own with another equity group, and we're actually selling it to ourselves. So we took it to market at the end of last year and got an offer, and we didn't want to part with the property because of the cash flow. And I'll tell you about the other opportunity in a second. But at Melbourne, we offered the other equity group, if we made an offer 1% higher than the market rate, would you sell it directly to us? And they agreed. So what's happening is we're buying that property. We'll have all new debt on it, be a sales transaction. And what's interesting with this property is we're not going to add storage. We're actually going to add covered parking. So when we went out and did an analysis in this marketplace, I believe it was 7 competitive parking facilities. Their average occupancy was 99%. So we have parking on the site now. It's full. And we went out and looked at the rest of the market and said, hey, there's an opportunity for covered boat and RV parking. So we're going to spend some money to do that. The nice part about parking is the cost per square foot to build it is much less than storage. As you'd imagine, it's just essentially a metal roof. And we can create some ancillary income items like trickle chargers for the batteries and pay extra money if you want to have those in your unit. But the price to build it is cheap, but the price that we receive in rent per square foot is great. So it's an interesting expansion opportunity where we're not building additional storage, but we're going to do some covered parking. Just really quickly, I'm going to walk you through the remaining properties and what the business plan was on each one. And just for the purposes of time, I'm not going to dig into the specifics on each property. But again, the due diligence documents are available for you to look at the pro forma. And if you have specific questions about a property, please let us know. The goal of putting these in here is just to let you know these are the type of assets that we're going to put in the fund. And so if we buy these 10 properties and add a couple more, the additional properties will look and feel very similar to this. We're not going to put a development deal, a ground up development deal, in a fund with value add and stabilized assets. So let me walk through, we talked about 5, 6 of them. Let me walk through the other 4 really quickly. So we have a property in Lexington, South Carolina, which is a great little market. Location's fantastic, right on the commercial thoroughfare, next to a brand new Publix. This is where you're going to do your commercial shopping. And this facility, the current owner built it in 2007 or 17. He's building an expansion, and then we're going to take it over once the construction's complete. So when he receives his certificate of occupancy, we'll take over the property, and the value add, we don't take the construction risk, we're just getting it leased up and getting that property to stabilization. So it's one that we're excited about in a market that we really like. The next property is in Oakland, Tennessee. So Oakland, Tennessee, just outside of Memphis, or Nashville, I'm sorry. So Memphis, I'm sorry, I said that wrong again. It's just about 30 minutes east of Memphis. The owner completed an expansion of climate controlled in 2018. His occupancy prior to that was about 94% for 3 years. So he had a really strong occupancy. We're currently at about 78%. I think that's jumped up with our most recent documents up to 80. But our business plan there is to take the asset, make it an institutional class, do some rehabbing, rebuilding some of the flow of the property, and ultimately get that new climate control building he built leased up to stabilization. They also don't have any retail sales there. They're not selling boxes, locks. They don't have any U-Haul, so we have some ancillary revenue streams. but an interesting market nonetheless in Tennessee, and has a good opportunity as their closest competitor is just over 8.5 miles away, which we don't get to see very often. This is definitely in a tertiary market, but there's an opportunity to be the only storage facility in a tertiary market. And where we are in storage right now, that's a unique opportunity for us. So we're excited about that one. Shifting gears to Jackson, Tennessee. So this is a property just about an hour east of Memphis as well. What's interesting about this one, why we really liked it, is there's 133,000 square feet of parking, which is a lot. And it's 100% full, which is also a lot. We don't see that very often. And so what was unique about this is we have an opportunity to add a little bit of storage, and their storage is doing really well, but another 37,000 square feet of parking because the competitors in the area don't have parking available. So we think there's a good opportunity to add some covered parking there. All right, I'm going to jump to the last property in the fund. This is the third property in Tennessee, in Springfield, Tennessee. And so in Springfield, this one will be buying an asset that you can see from the pictures. It's just not a pretty asset. We think the location's fantastic. We'll be the flagship in the market, and we're going to add a mezzanine level to a building that's already there. So we'll add a second floor that will include some climate control, about 20,000 square feet of climate controlled units. It works itself out to be about 261 units. We'll build that expansion and then get that leased up. So those are the 10 properties, and as I had said, I know we went through those really quickly. There's additional data there for you if you want to review it. A couple frequently asked questions I'm going to go through, and then we'll wrap this up. So first, investor distributions. When are they going to be made? So we expect the first distribution to be for the fourth quarter of 2019. And typically we make our distributions on a quarterly basis, 30 days post the quarter close. So if we're going to make our first distribution in the fourth quarter of 2019, then we'll send a check or a direct deposit to investors at the end of January. So, October, November, December, we close out the month, and then we get those distributions out to you at the end of the month. It may be sooner, but that's what our expectation is right now. Another question that we got from a lot of investors is what happens if we don't raise the $15 million minimum? We can't close on the first property until we hit that $15 million minimum. So once we hit the minimum, then we can close. If we can't raise the money, we'll essentially return any money that's been collected up to that point and reevaluate with our investors. And the goal of that is to ensure that if you invest, you actually invest in a fund, not one property, because that's what your expectation is up front. Another question is, are there any refinances projected in the returns? The answer to that is no. Although we're going to try really hard to refinance each one of these value add deals and return capital to our investors over that 6-year period, we don't have that in our projections. And we think that's where one of the upsides is for investors. If we can return capital to you sooner and continue our cash flow, well, then the returns skyrocket. So we do not have any in there, but we do expect to try really hard to refinance once these assets have been stabilized. When does Reliant deliver their K-1s to investors? So as I had mentioned, you'll be a member in the fund LLC. So at the end of the year, you'll receive a K-1 from us, which is basically like a W-2 if you're not familiar, for an LLC membership. And what's critical about this is we try to make sure that our investors get them in plenty of time to file their tax returns. So this year in 2018, we had all our K-1s out to investors by March 15th. We're going to work really hard to do that again next year. I don't want to make any guarantees, but we work really hard to make sure investors get it so they don't have to extend their tax return. Do you accept qualified funds, self-directed IRAs, 401ks? Yes, we do. If you need a self-directed IRA or you don't know what I'm talking about and like to learn more about it, let me know. We can get you connected with a self-directed IRA custodian or a qualified fund custodian that we work with. We're not affiliated, we don't get paid by them, but they've worked out really well with us in the past. Another question is, when does my 8% preferred return start to accumulate? And the answer to that is, when you, let's say you choose to invest $100,000, we take your $100,000, that $100,000 starts to accumulate as soon as we deploy it into properties. So let's assume we take 50 and 50 and deploy it into properties on July 1st and July 15th. Your 8% pref starts on each one of those days. 50,000 starts on July 1st, 50,000 starts on July 15th. If for some reason we don't close on your properties and we're just hanging on to your money, at date, we basically get a free 90 days of your money. So we can have your money for 90 days and not accumulate any preferred return. Day 91, your pref starts to accumulate. So if we've not deployed that into a property and closed on a property, day 91, your 8% preferred return will begin to accumulate. And we don't expect that to happen. If we're going to take money, we're going to have properties to close on, but that's how the document